2026 is right around the corner, and if you're serious about growing your wealth, you need to know where the smart money is positioning itself right now. We're not talking about gambling on meme stocks or chasing yesterday's winners. We're talking about 5 companies with massive upside potential based on fundamental catalysts that are already in motion. These are stocks where everything is aligning: strong fundamentals, favorable market conditions, upcoming product launches, and valuations that still leave significant room for appreciation. Stay with me for the next 5 minutes, because I'm going to break down exactly why these 5 stocks could significantly outperform the market in 2026. And more importantly, what specific catalysts could drive that outperformance. Before we dive into the specific companies, let's talk about what we mean by upside potential. We're looking for stocks that could realistically deliver 30 to 50% returns or more over the next year, which is substantially higher than the historical market average. To achieve that kind of performance, we need companies with clear catalysts. Things like new product launches, market share gains, margin expansion, or re-rating by Wall Street analysts who currently underestimate their potential. The best opportunities often come from companies that are misunderstood or overlooked by the broader market, where we can see value that others are missing. The first major opportunity lies in the artificial intelligence infrastructure space, and I'm not talking about the obvious players that everyone already knows about. There are companies building the picks and shovels of the AI revolution that are still flying under the radar. Think about specialized semiconductor companies that design chips specifically for AI workloads, or data center operators that are scrambling to meet the explosive demand for computing power. The AI boom isn't slowing down. If anything, it's accelerating, and the companies providing critical infrastructure are seeing demand that far exceeds current capacity. Wall Street is starting to recognize this, but many of these stocks still trade at reasonable valuations compared to their growth potential. As enterprises continue to invest billions in AI capabilities throughout 2026, the infrastructure providers are going to see massive revenue growth that could drive significant stock appreciation. Moving to our second category, we need to talk about healthcare innovation, specifically in the weight loss and metabolic health sector. The development of highly effective weight loss medications has created a market that's expected to reach over $100 billion in the coming years, but here's what most investors are missing. It's not just about the companies making the drugs themselves. There's an entire ecosystem of businesses that benefit from this trend. Companies providing metabolic testing, those developing complementary therapies, firms working on next-generation treatments with fewer side effects or better efficacy. These are all positioned for tremendous growth. As these medications become more widely prescribed and as insurance coverage expands, the companies best positioned in this space could see their stock prices multiply. The catalyst for 2026 is increasing adoption, expanding indications for these drugs beyond just weight loss, and positive clinical trial results from next-generation treatments. The third opportunity exists in the clean energy sector, but with a specific twist. We're not talking about broad renewable energy plays. We are focused on companies solving critical bottlenecks in the energy transition. Battery technology companies that are achieving breakthroughs in energy density or charging speed, firms building out the electrical grid infrastructure needed to support widespread EV adoption, or businesses providing energy storage solutions that make renewable energy more reliable. The Inflation Reduction Act and similar policies globally are directing massive capital toward clean energy, and that money is starting to flow to the companies with proven technology and scalable business models. The catalyst for 2026 is project completions, revenue recognition from contracts signed over the past 2 years, and proof that these companies can deliver profits, not just growth. As they demonstrate financial viability alongside their environmental impact, we could see significant multiple expansion. Financial technology represents our fourth major opportunity, particularly companies operating in the B2B payments and enterprise fintech space. While consumer fintech has been choppy, the digitization of business payments and financial workflows is accelerating rapidly. Companies providing payment processing for large enterprises, those building treasury management software, or firms enabling cross-border B2B transactions are tapping into markets worth trillions of dollars that are still heavily reliant on outdated systems. The beauty of enterprise fintech is the recurring revenue and high switching costs once you are embedded in a client's financial operations. Many of these companies are reaching inflection points where their growth is accelerating. Margins are expanding, and they're proving they can achieve profitability while maintaining high growth rates. The 2026 catalyst is continued strong revenue growth combined with improving profitability metrics that could drive significant re-rating by the market. Our fifth and final category focuses on cybersecurity companies, but specifically those addressing emerging threats that traditional security can't handle. With the rise of AI comes new attack vectors and security challenges. Companies developing AI-powered security solutions, Those protecting against quantum computing threats or firms specializing in securing cloud-native environments are addressing problems that every enterprise will need to solve. The cybersecurity market continues to grow double digits annually because threats keep evolving and companies have no choice but to invest in protection. What makes 2026 particularly interesting is that many organizations delayed security spending during the uncertain economic environment of 2023 and 2024, creating pent-up demand that's starting to be released. Companies with differentiated technology and proven ability to stop sophisticated attacks are going to command premium valuations as security budgets expand. Now, let's talk about why timing matters and why 2026 specifically looks attractive for these sectors. We're emerging from a period of significant interest rate volatility and economic uncertainty. As the environment stabilizes and as companies have better visibility into their planning horizons, investment cycles that were delayed are resuming. Capital that was sitting on the sidelines is being deployed. For growth stocks in particular, a more stable interest rate environment is positive because it makes their future cash flows more valuable in present value terms. Additionally, many of the companies in these 5 categories went through significant corrections in 2022 and early 2023, which means they're starting from more reasonable valuations rather than bubble-level prices. The combination of attractive entry points, improving fundamentals, and specific catalysts creates a compelling setup. Here's what you need to understand about actually capitalizing on these opportunities. First, don't wait for perfect confirmation. By the time everyone agrees these stocks are going higher, much of the upside will already be captured. Do your research now, build conviction in your highest quality ideas, and be willing to establish positions even if there's still some near-term uncertainty. Second, think about position sizing carefully. These are higher risk, higher reward opportunities compared to index funds, so size them appropriately within your overall portfolio. A reasonable approach might be to allocate 10 to 20% of your equity portfolio to these higher conviction growth ideas while maintaining core holdings in diversified funds. Third, have a plan for taking profits. If a stock runs up 50% in 6 months, it's perfectly reasonable to trim your position and lock in some gains even if you believe in the long-term story. The research process is critical here. For each of these 5 categories, identify specific companies by looking at revenue growth rates, market share trends, competitive advantages, management quality, and balance sheet strength. Read through recent earnings transcripts to understand what management sees as their key opportunities and risks. Look at analyst estimates and see if you think they're too conservative or too aggressive based on your own assessment of the market opportunity. Check insider buying and selling patterns. Significant insider purchases can be a strong signal of confidence. And pay attention to institutional ownership trends. Are smart money managers building positions or reducing them? All of these data points help you build conviction and identify which specific stocks within each category have the most upside. Don't ignore valuation even when looking for high growth opportunities. A company growing revenue at 50% annually might seem expensive at 40 times sales. But if they're in a massive market with a path to strong profitability, that valuation could be entirely justified and might even be cheap relative to where it trades in a year. Conversely, a stock that looks cheap on traditional metrics might be cheap for a reason if growth is slowing or competition is intensifying. The key is understanding the full picture: growth rate, market opportunity, competitive position, path to profitability, and current valuation, and assessing whether the risk-reward is favorable. So here's your action plan for the rest of 2025, heading into 2026. Take these 5 categories: AI infrastructure, metabolic health, clean energy infrastructure, enterprise fintech, and cybersecurity. Research 3 to 5 publicly traded companies in each category. From that list of 15 to 25 companies, identify your top 5 based on which ones have the best combination of catalysts, fundamentals, and reasonable valuations. Build a watch list and start tracking their quarterly results and any major news. When you're ready to invest, consider dollar cost averaging into positions over a few weeks or months rather than putting all your capital to work at once. This helps reduce timing risk. Set price targets based on reasonable valuation assumptions, and be disciplined about either taking profits when you hit those targets or reassessing whether the thesis has changed and the stock deserves an even higher target. The opportunity for significant outperformance in 2026 is real, but it requires action, research, and conviction. The investors who will look back a year from now with substantial gains are the ones who identified these trends early, did the work to find the best companies exposed to them, and had the discipline to hold through inevitable volatility. Markets don't move in straight lines, and even the best stocks will have pullbacks that test your conviction. But if you've done the research and you understand why these companies have upside, those pullbacks become buying opportunities rather than reasons to panic. The next 12 months could be a defining period for building wealth if you position yourself in the right places. And these 5 categories represent some of the most compelling opportunities I see for superior returns in the year ahead.